Morning, guys. Good to see you. Mona, let me start with you. Obviously, Target is arguing the consumer does have money to spend, but are we beginning to see some of the cracks that the Fed is clearly hoping to introduce without too much pain?
Yeah, I think it was interesting. I think Target's report this morning highlighted what the trends we've been actually seeing on an ongoing basis, which as the consumer started this year in a healthy position, excess savings still nearly $2.5 trillion above pre-pandemic levels, labor market healthy, healthy balance sheets and healthy spending trends. Where the pressure has been really coming from has been the supply side of the equation. So when we think about inflation broadly as a supply-demand dynamic, really the Fed is trying to impact the demand side of the equation. The supply side is a little less known, harder to handicap, depending on what happens with some of these supply chain pressures, really with some of the labor supply as well. But even the Target CEO this morning alluded to the fact that hopefully by the second half of the year, we see a clearing in some of these. And so, in our view, we do think from a market perspective, this market is really looking for not just one sign of lower headline inflation, but 2, 3, 4 lower prints in inflation to get a trend. And once we see that, that's really where we think we can get a more meaningful rebound in market, perhaps even a Fed that thinks about going at a more gradual pace. But until then, it seems like markets may be range bound, constantly going back and forth between the demand equation and the supply equation. But really what we need to see in this market is a better inflation dynamic.
Right. That certainly describes the recent period. And Jeff, I do wonder, clear and convincing, those words were clearly said for a reason. What do you think it represents? What is clear and convincing? How many prints is it? And how does it need to be framed by the Fed?
I think it may even be how quickly it happens. Look, what we heard from Target isn't just in a vacuum. I've been talking about this shift from shortages to gluts, which happens so fast it can surprise everyone. We're hearing it from Target, but GM CEO Mary Barra was talking about semiconductor supplies being normalized by the third quarter. We're hearing this shift from tight supplies to abundant supplies and perhaps excess inventories. Inventory levels are above average for most businesses right now. Work in process inventory is not finished. It doesn't take long to go from work in progress to finished inventories and products hitting store shelves, cars, game consoles, phones. So I think this could turn around fairly quickly. So it might not be that we need to see 4 or 5 or 6 in a row, but just some dramatic moves to the downside in some of these pricing pressures, at least on the pipeline side. That could be enough to cause the Fed to begin to pause. I'm not necessarily predicting that, but I think looking at to September or beyond and expecting further 50 basis point rate hikes in this environment of a rapid shift from shortages to gluts is probably expecting too much.
So, Jeff, then, if there is an inventory glut that you see out there, do you think that, just to kind of follow up on your earlier commentary and what Mona was saying about, the supply and demand dynamics and what the Fed can and cannot control, do you think there's an argument to be made that the Fed should just take a pause now and that things could come down on their own and we may not risk, a potential recession as a result?
Perhaps not yet. We know that supply chains are vulnerable to any kind of shock, and we're China to head back into another series of lockdowns. We know they're beginning to emerge now in Shanghai and other places, but that could exacerbate the problem. Another Ever Given stuck in the Suez Canal could exacerbate problems. We don't have a robust backup system right now, so any little shock to the global supply chain could cause these problems to worsen, and that's why the Fed should remain on its current path. But as we look out to later this year, those inflation pressures may be easing more rapidly than many expect.
Mona, you think that investors should be investing in a barbell-style approach given the current environment. What does that entail? What should be on either end of the barbell?
Yeah, look, I think generally in the near term, we are continuing to see this defensive posturing in the marketplace. And that includes in equities, of course. What's really performed has not only been energy, but it's been areas like staples, utilities, healthcare. These are considered typical recession-proof sectors, but also they have pricing power. Consumers will have to purchase healthcare, buy their utilities, buy their staples. And so in some ways, they're inflationary hedges as well. Value parts of the market have held up relatively well, especially as real yields move higher. Now, if we get to a point where we start to see the stabilization in inflation, perhaps we start to see a peak in yields and even a rollover in yields, that's really when we could start to see some of the most downtrodden parts of the market, some of the growth, higher valuation parts of the market start to perform well. Of course, on that space and in that space, we continue to favor the quality parts of growth, including those with proven business models, free cash flow dynamics, better earnings trends. And generally, when we look at earnings trends, the back half of the year and even early 2023, that's when we see areas like tech and discretionary and parts of growth start to outperform the value parts of the market. And so generally, whether we go into a lower inflationary environment or a lower growth environment, investors may start to seek out growth. So really in the near term, we're continuing to see this flight to safety in some ways. But over time, we think that can shift, hopefully as the inflation dynamic shifts, hopefully as the Fed shifts as well.
So, Jeff, when you think about it and you're getting these anecdotal pictures of how the consumer is thinking about goods purchasing, when you look at some of the big companies in tech that are pausing or even reversing a little bit their hiring plans, can you think of a likely scenario where the 10-year reclaims 320 and goes beyond?
It's possible. I think even as inflation pressures begin to recede, longer-term rates may continue to march higher, and that's one of the reasons why I'm still focused on short-duration stocks, low-price-to-cash flow companies. Cash flow is king right now. Those stocks have been outperforming in May, in April, all this year. In fact, since rates began to rise back in August of 2020, the outperformance has been staggering. So continuing to focus on low-price-to-cash flow, I think may continue to be a winner throughout this summer.
Good to see both of you guys. Appreciate you helping us start the hour, Jeff and Mona. We'll see you soon.